First, on to our very first topic at hand, and that is debt funds. The fixed income market is very much dependent on what the yields in the market are. So just as you have the Nifty and the Sensex, you also have the 10-year yield. Now, a lot of us do have debt funds in our portfolio, but a majority of us don't. It's largely been with a lot of corporate participation. Retail participation is only now starting to increase. So let's make sense of all the news flow that we have seen. Firstly, momentum in yield. Secondly, a new cutoff yield of 6.1%, which is, by the way, a little higher than what it was earlier. Thirdly, the different mix of debt funds that you should have in your portfolio. As we know by now, there are different kinds of debt funds, just how there are different kinds of equity funds. So let's make sense of all of this. I have with me Akhil Mittal. He's a senior fund manager with Tata Mutual Fund. Akhil, thank you so much for taking our time and joining us today on The Money Show. So first, let's sort of make sense of the correlation between movements in yields and debt funds. So for the most part of this year, we have seen yields spiking, and debt funds meantime have not given really the best of returns. So what's the correlation there? And now that we're suddenly seeing debt yields dropping, what does it mean for debt funds?
Okay, so interest rates basically work in an inverse proportion to prices. So if the interest rate goes up, the price of fixed income instrument that you hold goes down, and vice versa. So if the interest rates go down, the price goes up. As you said, for major part of this year so far, the yields have been inching up. So which means that hypothetically, if you invested at 5% and the yields are at currently 5.5, then you have actually incurred a 50 basis loss. So to the same extent, there'll be a drop in price, and hence, the returns of the debt funds would be impacted negatively. So large part of this year so far, interest rates have gone up, and hence we are seeing the returns of debt funds are subpar as compared to the previous cycle, previous 2-3 years, 2018 to 2020, when interest rates were coming down in a sharp manner, and hence the returns were going up. So basically, it's a inverse relation between interest rates and the price of debt funds.
Okay, so that's essentially the understanding of what happens when yields move, and what's the impact on debt funds. Akhil, so right now, firstly, what do you think has triggered this downtick in yields that we've seen, in India?
So we have to, kind of get used to all the factors that affect interest rates. So starting 2021 January, was when RBI first indicated that, they will be withdrawing the excessive accommodation gradually, and hence they started withdrawing liquidity from the market. But come March, we had the wave 2 of COVID hitting us, which meant that RBI stopped pulling out liquidity from the market. Globally, central banks, including Federal Reserves, started indicating that, their policy will now start shifting towards normalcy, and they will withdraw excess accommodation. So, which led to a global sell-off in yields. Domestically in India, a couple of things have happened. Number one, the inflation has gone up substantially, which basically means, the monetary policy setting, which targets inflation. Now, if inflation goes up, it would be preemptive to think that, the monetary policy will now shift from accommodative stance towards neutral stance maybe. So hence, once you think that interest rates are no longer going to go down, in fact, inflation is going up, so monetary policy probably will have to target inflation. So the interest rates also started inching up. So it was a combination of global factors, inflation domestically, and also an expectation that, sooner or later, RBI will have to withdraw the excess accommodation done in the economy to meet the COVID crisis. So by excess accommodation, we mean any accommodation which is over and above the normal policy zone. So in March 2020, April 2020, RBI did excessive liquidity, flushing in the system so that the economy or all the important sectors, whichever are getting impacted by COVID, they get enough liquidity and money to continue their businesses. So these kinds of factors did result in interest rates or yields inching up.
do you think, Akhil, that, like you mentioned, given the fact that this accommodative stance will have to be put on hold sooner rather than later, do you think that this range of yields that we are seeing will be here to stay and we won't see any dramatic spike then from here on?
See, we have to see the interest rate cycle in two phases. Firstly, a medium-term phase, and secondly, a shorter, nearer-term phase. As far as the medium-term or a longer-term phase is concerned, one thing is very clear that the easing cycle is behind us, which means that the next a fundamental shift of the policy will be towards the normalcy, which means that interest rates cannot go down. They can either stay here or they can go up. The second part is, the economy is struggling with the impact of COVID wave 2. To the extent RBI and government both have taken lots of steps to, to sustain the economy, to support the economy, and it would be slightly premature to withdraw the accommodation immediately. Rather, we know that inflation is high, but supporting the economy and growth is also very important. So RBI has taken a stance that they will continue supporting the economy with all tools available, which means that the shift towards normalcy is slightly away. It will happen, but it is slightly away. RBI would want to see that their steps in the past have resulted in positive impact on the economy, and hence economy is moving ahead. At the same time, there is a possibility, or there are lots of literatures going around for a possible wave 3. Any central bank would also want to, see off that risk before moving the policy. They don't want to move the policy prematurely and then again, if wave 3 comes, then again move the policy. That leads to policy volatility. So I guess for some time, for near-term interest rates will remain range-bound and thereafter most likely shift upwards.
All right. Okay, so that's, I think an in-depth thing on yields that we have discussed. Now, Akhil, we read the news that the RBI has announced a new cut-off yield for the new 10-year bond, and it is higher than the current benchmark. If you could explain the significance of this from the point of view of debt funds and debt fund holders, what exactly does this mean?
Okay, so a 10-year benchmark yield is basically considered as the benchmark interest rate fulcrum for the economy. Like we say Nifty or Sensex in equity markets, similarly there is a benchmark yield in interest rate markets. So 10-year benchmark generally is a barometer of checking the interest rates or the level of yields in the economy. Now what happens is Government of India borrows from the market, and the RBI issues securities for that borrowing. These securities vary across the tenure, so they borrow from 2-year, 3-year, 5-year, 10-year, all the way up to 30, 40, 50 years. So RBI does auction these securities. Now every security has a certain kind of amount that RBI issues. They can't go on issuing unlimited amount on a particular security because interest rates change and the tenure of the security changes. So approximately we can say about 1.2 lakh crores, 1.3 lakh crore in that range is what RBI issues for a particular security. Now the old 10-year benchmark, which was 5.85 coupon, the outstanding of that reached that level of 1.2, 1.3 lakh crores. So government had to issue a new 10-year. Now the relation generally goes around that whenever you get a new benchmark or a new security, most of the trading volume shifts from the older security to the newer security, which means that any trading positions which were there in an older security will now shift towards the newer security, which would generally mean in a buying-selling equation would mean that you will see sell-off in the old security and buying in the new security. Traditionally, the new security, let's say a 10-year benchmark, when it is issued, it comes at around 15 to 20 bips below the existing benchmark. This time that did not happen. The yields were largely in a similar band. Two reasons. Number one, the old benchmark, lots of trading, outstanding trading volume in that security was going down because RBI was buying that security in the GSAP, in the open market and in OMOs. So lots of outstanding amount of that security had already gone into RBI's books. So traders were generally light on that security. So the concept of a sell-off in the old security did not work much there. However, given the fundamentals of the economy, you would always want a certain level of interest rate to invest your money or to deploy your money. So in that sense, the new 10-year yield came at 6.10, which did take the market by surprise because it was around 5 to 6 basis higher than market expectations. It also bridged the gap between the old security and the new security. It was purely two-sided. One, the sell-off in the old did not happen because RBI bought a large amount of that security. Number two, traders wanted to buy the new security at a particular yield on the forecast of their interest rate targets. So that led to a closing up of gap between the old 10-year and the new 10-year. Now, as far as the significance of 10-year yield is concerned, if you recall, RBI a couple of policies back had also mentioned that most of the interest rates in the economy, be it for the corporates or be it for the individuals, banks tie those interest rates on loans basis a benchmark, and then 10-year GSEC does provide as a mirror barometer for most of the interest rate setting in India. So the yield on 10-year to that extent becomes very important and very relevant for most of the interest rate setting in India. Hence, RBI also said it's important to manage the 10-year yields so that the overall interest rates in the economy can be managed in a better way.
Okay. Understood. So, just a simple explainer for all of our viewers to make sense of what this news means, because, as debt fund holders, it's good if you at least have a working knowledge of how, the news impacts your investments. Okay, I want to talk about different kind of categories now. Gilt funds, for one, on an average, they have given good returns in the last 2-3 years. I mean, I think except for this last 1 year, prior to that, we have seen double-digit returns for, I think, 2 to 3 years consecutively. What do you think has been the trigger? And now, in the last few months, returns have been slowing down. What is the reason for that? And what is the recommended action for current Gilt fund holders, according to you?
So as we started, the inverse relation between interest rate and bond prices. Now, if you go back to 2018, 2019, 2020 cycle, this was primarily an interest rate cycle where interest rates were coming down, yields were coming down. So if the yields are coming down, the prices of the bonds will go up. Now, GSEC and funds generally invest in longer duration gilt securities, which means that the sensitivity to interest rate is higher. So longer the duration, higher the sensitivity. That's the equation. So if the interest rates are coming down, then gilt funds would do better because there will be a larger price appreciation. So 2018 to 2020 cycle was basically a cycle when interest rates were coming down, yields were coming down, hence the prices on the government securities were going up, which resulted in a very high return on the gilt funds 2018, 19, 20. Come 21, now, as we have already discussed, given all the fundamental factors, given where the economic cycle is, given where the monetary policy cycle is, it's expected that interest rates or yields will go up. Now, if the interest rates and yields go up, then going by the duration sensitivity logic, if higher the duration, you will have higher the impact on the negative side. Hence, the longer duration funds have not done particularly well over the last 6-7 months. So that is how the equation goes. Now, if you see through the cycles, we are already past a easing cycle. We are now in a cusp cycle. Going ahead, most likely we will shift towards neutral policy zone, which means that, such shifting would generally mean interest rates or yields going up. In that kind of a cycle, what would one want to do is one would want to reduce the duration so that as interest rates goes up, the sensitivity to interest rate reduces. So if I'm holding a longer duration fund and interest rate goes up, then the negative impact will be higher. So to reduce that negative impact, what shall a person do? One should look to reduce the duration to such an extent, where the negative impact is minimal or lesser as compared to longer duration funds. So if total returns are a function of accrual and alpha earned out of duration. In a cycle wherein interest rates shift from accommodative stance to a neutral stance or to a tightening stance, the duration alpha is minimal. So one has to reduce the duration and concentrate more upon accruals in the upcoming cycle.
Okay. All right. Well, that's of course about Gilt funds. So, just before we move on, I want to ask. I'm going to roll a few questions actually together for the benefit of saving time, Akhil. So on one side, you have inflation, which seems to be staying above the 6% mark. Fuel, of course, being the key problematic figure. So I don't see inflation dipping below 6% for at least the next few months. So inflation is a problem. We know what's happening with the yields. You've comprehensively explained all of that. Giving these factors in mind, what's the best debt fund mix to have right now for retail investors that will help protect the purchasing power of your money against inflation and, of course, make the best of what the yield situation is like currently?
So given the cycle and given our view on rates, I think a good mix would be that to reduce duration, which means you exit the longer duration funds. You concentrate more on accruals, which means you enter accrual funds at the shorter end of the yield curve, which basically means, let's say, a 6 months fund, a 1 year duration, a 2 year duration, that kind of a duration, which is basically your low duration to the short term category. That category will be lesser sensitive to interest rate movement as compared to longer duration category. So number one should look to reduce the duration. In case they are invested at the longer end of the duration curve, they should probably look to reduce allocation there and increase allocation at the shorter end of the curve, so that broadly their sensitivity to rates come down. And within the shorter end of the curve, one should always also be aware that duration and accruals go hand in hand. So in case one intends or wishes to reduce the duration completely, that will come at the cost of accruals. Now we know in debt funds a person would invest to earn a regular accrual. So one has to find a mix wherein the duration impact is much lesser, and at the same time there is a regular accrual. So something like a low duration fund, floating rate fund as a category would do very well in such a cycle, because by logic of the fund, the fund will move in direction with the interest rate. So if the interest rates go up, the earnings of the fund will also change accordingly, and if interest rates go down, the earning of the fund will also change accordingly. So one can look at low duration funds, floating rate funds, maybe some allocation towards short term debt funds, wherein the duration is not very high and the accruals are there. So the idea is keeping the total return equation in mind, increase the accruals, reduce the duration, so that the impact of negative alpha from duration is lesser and accruals are intact. This would mean lower returns for some point in time, because higher the duration, higher the YTM, lower the duration, lower the accrual. So this would mean slightly lower returns, but at the end of the day, total returns is what matters. So one has to reduce the possibility of negative returns herein and concentrate more on the shorter end of the.
Okay. All right. Well, Akhil, we leave it at that. Thank you so much for joining us and giving us a comprehensive, analysis and explainer for yields, inflation, what the outlook is on both of these, and how it will impact debt fund holders as well. Thanks once again for joining us.